Hey there, everybody. Welcome back to the Finding Financial Fitness podcast. I'm your host, Nino Gonzalez, joined again by Pei. How's it going?
How are you?
We're very good about educating me on the difference between what the difference is between what a tool is and what a strategy is, and how we can incorporate both of those into our fitness journeys, but also our financial journey. So can you start us off by kind of explaining the brief difference between what a tool is and what a strategy is?
I think as an investor, we are always kind of inundated with a lot of information, and it's hard for, especially for new people coming into this space, to decipher like what am I getting, right? A tool is kind of a one-time thing or something that you would use towards an end goal, mostly financial freedom, right? But strategies can kind of sometimes get mixed up in there, right? Strategy is a way of using these tools, whereas a tool is just a tool, right? For example, it's easier to just use an example. For example, a home equity line of credit. It has many different uses. You can use it for many different ways. You can use it to buy a car. You can use it to go on vacation. You could use it to pay for tuition. Whatever you do with it, but it's a tool, right? There's nothing. The way that you use it is the strategy of it, right? Some people like us in our community, we use this tool, the home equity line of credit, to invest with, and so what we invest in is then perhaps another tool. So sometimes the product then seems like a strategy, but it's really not. It's just a product, right? Actually, funny thing is that we actually are going to be soon interviewing someone very exciting, just a sneak peek, right?
Yeah.
Someone who offers this very special product called the all-in-one mortgage. And that is a fantastic, phenomenal tools if, right, you deploy it properly.
Right.
Debt is a tool, right?
Controversial.
There's strategies on how to use the debt
Right.
to create. And the process of doing that is the strategy part. Infinite banking is also another thing where there's a lot of confusion out there. People think of infinite banking as a tool. No, the life insurance product, that's the tool. But the way of interacting with that tool is the strategy. So we have to kind of learn about that so that when you encounter these things, you don't get confused. What do you think?
Yeah, I think that we talked about before in previous podcast episodes, kind of goals, right? And overarching goals and what we're trying to do. I think as we need to start at the macro level, right? Which is identifying our goals, which is what we've talked about. And I think listeners at this point are wondering, okay, when are they going to get to the juicy stuff? When are they going to get to the stuff that actually tell me what I need to do to make money? Tell me what I need to do to be healthy. And I think that you need to start with the goals first. You need to start with the big picture so that when you start utilizing these individual tools and incorporating those into strategies, they're ultimately lining up with what your goal is, right? If you don't have your goal down, you can have all the tools in the tool belt, but if you don't know what project you're building, what good is a tool belt full of tools you're not going to use, right? So it's important to start with that. And one of the things that I think you had mentioned in the past was delayed gratification. And that's how I personally had lived my life. But there's a point of the concept of delayed gratification means you're delaying gratification. You're not terminating gratification. There has to be a point where you recognize that gratification. And I think the sooner that you're able to identify, okay, here's what I'm going to do for the next 3 to 5 years. Here's the tools I'm going to use. Here are the tools I'm going to use. And I'm going to build that into my strategy to reach my goal. And that's why I'm delaying gratification. So I think that putting in that context is very important. Otherwise, we're just delaying for the sake of delaying, and we're actually never getting the gratification, which it could actually be miserable if we're not enjoying the process. So I definitely like the concept of understanding the tools versus the strategies. Do you want to give it your example of what you always mentioned, the penny a day story?
Oh yeah, I love this story because when you're mom, you always try to teach kids. This is a very difficult concept for kids, right? So you kind of want to test your kid. We use, instead of money when they're young, you use like marshmallows or cookies, right? Yeah. Like, would you rather, right, I give you this cookie right now, or would you rather wait 2 hours after dinner, then you can have the cookie and ice cream, right? So you kind of teach them that way. But for adults, right, obviously we understand math better. So here's a very simple question, right? Would you rather that I give you $1 million today, just cut you a check, or would you rather take a penny that doubles every day for 31 days? And anybody can Google this and see the math. What do you think? What would you take, right, as an adult? You'd be shocked.
Well, I mean, naturally, I remember when I when I first read this, I thought, no, that's dumb. I'm going to take the $1 million. And the reason why, I'll tell you what my reasoning was. This goes to the way my brain thinks. I thought, okay, I'm going to take that $1 million today because I don't know what's going to happen in 31 days. What if I'm not alive in 31 days? Something happens. So that was my original thought process was you never know what's going to happen. And mind you, I had just come from reading Die with Zero, 4,000 weeks, right? Learning about life being short. So when I had read that, I was saying, okay, well, I'll take the $1 million. But quickly, a paragraph later, I figured out why I was wrong. And that blew my mind. I had to read the answer multiple times. What was the total that if you take the penny, doubling every day for 31 days, do you remember the total at the end of 31 days, roughly what it was?
By the 31 day, it's I think $5 million.
Crazy. And it's not, what blew my mind about that is tying that into delayed gratification. The kicker, like the real growth doesn't happen until like day 27, right?
Until, yes, exactly.
Right? Like
Until
once you get to day like 26, 27 is when it just blows up, right?
Yes.
And it's thinking long term. Part of that is also thinking long term. Part of that is the delayed gratification. You're not going to know, right? You're waiting for 31 days, but you're at day 26, 27, and you're thinking, I could have taken that $1 million sooner, and maybe I want to take that money out. Of course, we're talking about hypothetical situation here, but it goes to real life where so many people are so close to breaking through that tough barrier, and on the other side of that is what they're really after, whether it's a financial goal or a fitness goal, but they're so close, but they can't see it through because it's a whole new world for them. So I think that example
So here's
is
one more question.
Yeah.
Let's extend that, right? Let's talk about that example of compounding. I want to bring up this whole point of that whole thing got to $5 million by the 31st day is because of the uninterrupted compounding, right? Nothing happened. You never took out the money. So I think there's some math, somebody like if you were to take out, say, some of the money midway by the 20th day or the 15th day, let's say you took out partial of that money, what would happen to your, I haven't seen the math on it, but I'm sure it actually creates quite a big, huge impact at the end, right?
Oh no,
and
I
then
definitely think that one of the books that I read, they mentioned that if you took it out like at day 15 or 16, the impact is like a $3-4 million impact. And instead of getting the $5 million on day 31, you're getting 1.1 million. And in that case, it would have been actually better to take the $1 million at the beginning of the month because you would have then been able to put it somewhere else and let it compound. But go ahead.
Exactly. So the power of uninterrupted compounding is huge. And we can talk about that later when we discuss IBC. And then that other question I have would be on day 31st, when you have the $5 million, will you have the willpower, the strength to say, I met my goal, I'm good?
Ooh, that is,
because if you just wait one more day, that would be 10 million. Would you have the willpower to say enough is enough?
And that, oh man, that is, you always do this. You always spring these questions on me that put me, that is the question that I think so many people before they start the journey think they know the answer. But once you get to day 31, you are really, really, really struggling. It is a struggle because you're able to start asking questions when you have a certain level of income. Your lifestyle's covered. You have lights over your head. You're able to do the things you enjoy. And at that point, you're asking that question. And we talked about this in a previous podcast. Is more money going to truly make me happier? But when you know how long it took to make that $5 million in 31 days, and you know that you could then double that again in one day, how do you pass that up? But then again, when does that stop? Because in theory, on this example, that never stops. You can go to day 365 and you're talking about billions at this, well, more than that, trillions at this point. But then what if you die at day 200 and you thought, well, I'm going to wait till day 365 to start recognizing all this money? And that ties to the principle of die with zero, and also the concept of understanding your goals. Because if you understand your goals very, very clearly, you can take that money out. Now, if at the end of day 31, I think that here's my answer to your question. I would take that money out at the end of day 31 and I would rephrase my thinking and ask myself, okay, what do I need now? And maybe out of that 5 million, maybe I don't spend all of it and use it for the rest of my life. Maybe I take half of it and let the other half compound and still reinvest half of what I have. But then I can use the other 2.5 million to increase the quality of my lifestyle, right? But I'm doing the best of both worlds. I've taken money out to spend on myself. Yeah, I put money back in and it's not going to compound at the same rate as what it would have if I kept the whole amount in there, but I'm already living my dream lifestyle, right?
By that time, it's almost like is your lifestyle is going to improve that much better? I guess for some people it would, right? That's the difference between a private jet versus,
Owning the
a shared,
airport.
right?
Yeah,
A
right.
shared jet experience versus a private jet experience.
Right. And when is it enough? And we talked about like being happy enough, and there's no one, we can't give you that answer, because that answer is very subjective. That it all comes down to what you value and what you find important. And nothing wrong with that. As long as you can identify that early on and be okay, because I don't think when you start on this investment journey in a financial world and even on the fitness world and you start achieving these things, I don't think people realize how once you get that momentum going, the momentum keeps going. You have to really be proactive to actually make the momentum stop. Once you learn the fundamental techniques and tools and implementing the strategies using those tools, you can't unknow what you've learned. And it's very difficult to go back the other way and just become a spender and go crazy and lose all your money. It's actually very difficult to do that, in my opinion. But speaking of talking about tools, what are some financial tools that you find to be very valuable? Maybe not the strategies quite yet, but what are some tools that you find very important that you've learned about in your financial journey?
Gosh, I mean, it kind of evolves, right, over the years. Tools wise, I would say most on the most basic level. Of course, stocks and whatever. Those are just tools. I personally am not a big, huge fan. I don't like to invest in stuff that I am not very familiar with, and I certainly don't know how the stock market works, right? I can blindly trust that they will in general go up, right?
Right.
But yeah, I mean, but it's a tool. It's definitely a tool out there, right? Stocks, mutual funds, those are tools. And then, of course, turnkey real estate, right? Or that doesn't have to turnkey. It can be just, even if you want to self-manage, right? Real estate is another tool. There's a lot of strategies involved in how to get there, but ultimately, if you look at it, it's just a tool. So those are two kind of most popular, I would say, that people are familiar with. In the recent years, we obviously came across a variety of different things that offer like investing in business, right? There are those people who flip businesses. Like you can buy a business, come in and optimize their operations and improve their processes and whatnot, and then basically, so buying a business, a cash flowing business, is also a tool. So there are a variety of different things. A lot of people, I think, when they're kind of jumping from the employed W-2 world to the investor world, you kind of have to go through that process. It's really, really difficult to just jump from a W-2 directly into the investor world, right? Because you don't know how to read a profit and loss statement. You haven't experienced anything yet, right? Because all you see is everybody else getting paid.
Right.
But then Murphy's Law is the minute you buy into it, if you're unfamiliar with the industry, if you're unfamiliar with what it is about, chances are that deal's gonna go bad because you just started. Sure. So that's why, like, on the journey to become an investor, it's good to try different things and not just kind of be all in on one and one only. What about you on your investment journey? What have you come across that you feel like are like must-haves for?
Yeah, it's funny because I do want to touch on the stocks that you mentioned. Something that came to my mind was actual versus average return. So I remember when I was a W-2 employee and I learned about 401k, right? They came to speak about the 401k. Put your money in our whatever fund, the Vanguard, you name them. So I said, okay, well, I'm going to put X amount of percentage contribution to my 401k. And I remember them telling, not just them, but the media, and hearing about it. Oh, over the last 100 years, the stock market has averaged 7 to 10% growth every year. I thought, that's cool. If I put in money now, I know that it's going to grow by 7 to 10% every year. And I was doing this for a couple of years, and it wasn't until I put on a different set of lenses, right? Which is kind of thinking in a different way after reading Becoming Your Own Banker, which we'll dissect in terms of how to use the life insurance product, dividend paying whole life insurance. We'll discuss that strategy of IBC, infinite banking. But when I read that book and I realized actual versus average returns, and I realized, well, some years were returns of 10, 15% or 7%, what they promised. But then what happened during the pandemic? What happened during the crashes? Well, they were negative 30%, but the average between negative 30 and 30% is zero. So there's technically no money lost. However, if you had $100,000 and you lost 30% of that, well, you're down to 70%. If it gains 30% again the next year, you haven't gained your 30,000 back. You've gained very little of it back. So now you're having to chase that recovery. So Yeah, you might be in the stock market for 30 years and your average quote unquote rate of return might have been 7%, but you might have actually lost money over the course of the 30 years that you were in it. So
Yeah.
I know you've mentioned that before. So is there something you want to kind of add on to the actual versus average returns?
Well, that's actually a similar concept, but we're just talking about that penny double every day, concept, right? When you
Right.
interrupt that growth, which is maybe in the stock market, it's a down year or consecutive down years, even, right? You just have much less money earning or working for you. I like to think of my money as my employee, right? It's a mindset shift. Instead of working for my money, my job right now is to manage my money working for me, right?
Okay.
So if you think of your money, your dollars as your employees, right? You want them to be constantly working, right? You don't want them to be taking breaks. So that uninterrupted compounding is your employee working 24/7, never taking a break, right? So same thing with the whole concept that we're being sold, right? With the 401k, IRA, all those things. It's the average rate of return that looks really great on paper, but nobody ever looks at their actual account balance. You put in that money, right? And you're promised a 10% return. If that was true, your balance, I guarantee you, if you open it, will be a lot higher than what it is, right? Because just the fact, but the fact that when it goes up, maybe they decide to sell some stocks on the downside to just like, there's no point to put more good money after bad dollars, right?
Right.
So sometimes your fund manager or whatever, they sell it, to take the loss, right? And then they put the whatever, say you have $100,000, invested in something, they decided to take a 30% loss and just you're left with 70,000. Now that 70,000 of your employee your employee force just got shrink down, right, by 30%. You only have 70% of your employee force at work. The production is just not going to be there, right? You have to build back up to your original amount to, go back in and work and earn more money. So that is just one of those things I find is not talked about at all. Actually, there's out there, it's just everybody just said, oh yeah, what is the rate of return, average rate of return, and they're so stuck on that, and it's hard to convince someone to kind of look at it differently, right? So yeah, it's a definitely a challenge, I think, when I'm talking to newer people who are looking into kind of the alternative way of working with their money. Definitely a challenge. I think it's the same in the fitness world, right? Like all these new ideas that come up, it's hard to get through to people.
Oh, for sure. And I think going back to what you were talking about, just on the finance world of tools, right? Stocks, real estate. I think those are the ones that people will know about the most, right? Everyone talks about real estate is the easiest way to wealth or the most well-known way that you are in control. And that's true. And that's I think within the sector of tools, those are the macro tools, right? You can have tools within those tools as well. But some other tools you mentioned, like a home equity line of credit, I think is a very common and really good tool. But what that gets at is leverage, the concept of leverage, of accessing money that's other people's money. OPM, another very common word, maybe not as common as stocks and real estate, but I think leverage is a huge tool that can be used when strategized correctly, right? There's also, I think it was Charlie Munger that quoted this, or it might have been Warren Buffett, that said the three ways that a man can go broke: ladies, liquor, and leverage. Right.
Yeah.
So it's one of those things that if you're not smart with your strategy on how to utilize those tools, you can actually become worse on the way out. So I think that that's a great tool. Life insurance, like we mentioned, specifically dividend paying whole life insurance. That's a great tool that can be paired with a strategy of the infinite banking concept, which I think is one of the keys to wealth and also generational wealth. I think those are really key strategies. We talked about the all-in-one mortgage, which is essentially a first position home equity line of credit, but it also ties into the checking account, which we'll talk about later on, but it acts as what's called a sweep account, which again, that is also a tool on its own where you're using your mortgage and you're tying that into your checking account. So anytime you get paid, you're basically paying down the principal of your home. So I won't go too much into it because we'll have an expert that can very well articulate that to us. But also with the tools on the financial side, there's a lot of noise, but there's also a lot of noise on the fitness side when it comes to tools. And any diet that you hear, the diet is not the strategy. The diet is the tool, right? It all comes down to calories. And if however you're going to get down to, it's called CAICO, calories in, calories out. However, no matter what you do, if the strategy of being calories in is greater than calories out, you are going to gain weight, and vice versa. If your calories out is greater than your calories in, you're going to lose weight. That's the basic strategy. And there's multiple tools you can use to help improve that strategy. Okay, maybe I want to try fasting. Well, how does fasting work? Well, the strategy behind that tool is that you're reducing your window of eating, and therefore you're cutting down on calories. Why does a ketogenic diet work? Well, you're cutting down on carbohydrates, which again, in theory, you're cutting down on calories, which back to the equation, calories in, calories out. There's different ways of physical training, right? There's, okay, you can go running, you can go lift weights, you can do yoga. Those are all tools. But if your strategy is, I want to gain muscle mass, going for 5-mile runs every day is actually going to be a hindrance. You're completely counteracting the strategy of what your ultimate goal is. So I think it's easier to just, I think there's more concrete evidence of tools that work in the fitness world than there is in the finance world. And I say this because the finance world, those tools are subject to human error more so than the fitness world. I think they're still similar, but I think in the finance world, you have to have a very clear strategy. And that's where coaching is phenomenal in this, because you have people who have been there, who are seeing your financial picture with clear eyes. I think that really does help. So something else I would add to the tools is coaching.
I was just going to ask you that question. Do you think that people are more open to hiring a coach for their financial journey or for their fitness journey? General, fitness journey.
Yep. And whether or not I agree with that really doesn't matter. But I think that because you see and I'll say why. It's easier to become a fitness coach than it is to become a financial coach. Just point blank. I'm telling you right now, you can go online and type in personal training certificate, and you can get your personal training license certificate. It's not even a license. You can get it in 3 days over the weekend. You do it today, you'll be a personal trainer by Monday. You don't have to have any qualifications. You don't have to pass a fitness test to become a personal trainer. Right? You can be doing the complete counter opposite of what you're recommending, but you can become a personal trainer. In the finance world, yeah, anybody can practice and say, well, this is not legal or financial advice. And many people have YouTube channels and podcasts portraying information that's actually detrimental to individuals. To actually say you're a finance coach, to become that is a little bit more difficult, in my opinion. So therefore, I think people are, because of the variability and the options that are out there for personal training or nutrition coaches in general, because it's easily accessible, I think people are more than likely to sign up for that and ask for help in the fitness world than they are in the finance world. Also tying into the fact that I think there's still a taboo about talking about finances.
Yeah, absolutely. And part of it too, I think it's hard to quantify. There's a cost, right, to everything, right? We pay coaching costs all the time because I believe in education. Right, you're paying tuition one way or another. There's no way around it. Right? You're either paying tuition because you're gonna lose money on some deal, and that's street cred, 100%. You pay it, or you're gonna, like we kind of discussed, right? You're gonna pay somebody else for their expertise, their 1,000 hours that they put in, or their failures that they experience. They can come in and say like, oh yeah, look at this. This is exactly what happened the last time I did this deal. These are the red flags, right? I can pay for that. I'm totally happy doing that. But I think the cost and value, that's a huge discussion, right? A lot of people are stuck on fees, right? Anytime, right, when they look at something or a product or a tool that comes up, some people immediately, their first reaction is, oh, that's very expensive. The mindset is, it's a cost to me, versus over the years I've trained to look at it and say, well, how is that tool going to help me? The cost of it is my investment, right? I'm investing in this either product or coaching or services or whatever to help me accelerate. And what's the potential, right, on the back end? How is that? Is that going to speed things up for me? Is it going to make my goal better? There's different value that you place on the cost of different things.
Well,
so
I think something with that I understand where people are coming from is, I think the reason why people see it as a cost, and I mean this about all coaching, is because results aren't guaranteed, right? If you would tell them, I can guarantee you this, I think most people would actually invest the money because they know what the outcome is on the other side. And that's one. And the second thing is the credibility. How do you know when you're going to go find a fitness coach, a financial coach, how do you know their level of expertise? How do you trust that the advice that they're giving you is in your best interest from years of experience or from working hard to learn to then educate you? I'm going to speak for myself here as a diet, like a clinical dietitian. I had to go through my bachelor's, so 4 years of my bachelor's, 4 years of 2 years of a master's, and then 1 year of dietetic rotations in a hospital setting. So all in all, I'm looking at 7 years, all with the one focus of becoming a registered dietitian. But you go out on the street today, most people don't know the difference between a dietitian and a nutritionist, right? They say, okay, I need help with nutrition. Okay, well, I'm going to go reach out to a nutritionist who's charging me $20 an hour versus seeing a dietitian. You might have to go through your insurance and you're paying out of pocket $80 an hour and the insurance company's covering the rest or however much it might be. But you see the discrepancy in cost and you're thinking, well, I'm going to go with the person who's cheaper because I don't know the difference between their qualifications. They both practice nutrition. And therefore that's how you end up spending more going from nutritionist to nutritionist than if you would have just gone with the dietitian in the first place. Right. So keynote to that. If you're looking for nutrition advice, I would always recommend look for a registered dietitian because that person, has gone through rigorous schooling. Doesn't mean that they're a better counselor or a better actual coaching status, like being a coach, than the nutritionist is. But that they're what they know, you have a baseline understanding of what they know. In the finance world, I don't think that that's very crystal clear unless you're going into a fiduciary, unless you're dealing with an actual licensed broker. And even then, they know their little world. That's the problem, right?
Well, even then, fiduciaries, they can still sell products. So, and I get it, everybody have a family to feed, and I totally get it, right? I'm
Yeah.
not going to be, saying that, oh yeah, everybody should volunteer trade times and for food. No, everybody should be properly compensated for their effort and their contribution. But there's just a lot of people out there who, in the financial world, the huge challenge is it's almost like, especially if you look at the internet gurus or whatever, right? You almost wonder, like, did they become rich from their social media and all the other sources of income that they produce, or they became successful first and then now they're sharing their knowledge? It's really hard to discern that, right?
Yeah.
So yeah, it's definitely a struggle. Like, and then there's the category of financial entertainers, right, where they're out there to give advice, but in a more extreme way to get clicks, right, or to get a following and stuff. And they themselves don't necessarily follow those advice that they are giving out to the populace, right? They're doing something completely different, but they're telling you to do something.
Which kind of goes to the point of another reason where I think it becomes almost easier, but also can be tricky in the fitness world is I'm under the belief, and this goes with anything, fitness, finance, anything. I don't want to learn from somebody who is not more knowledgeable in the subject than I am. Very simple. If I want to learn Spanish, I'm not going to go to an instructor who says they're bilingual, but can't hold a conversation with a native Spanish speaker. I'm not. I can understand some Spanish. If I understand the same amount you do, I don't want to learn from you. It's the same concept in fitness, right? And I know this might be a little bit controversial, but if I'm going to a fitness instructor specifically with the goal of gaining muscle or losing body fat or losing weight, and that person isn't embodying the lifestyle that I personally want, I'm going to question that, rightfully or wrongly. That person might have had their own experiences and their own knowledge, but I need to have a filtering system quickly to identify I trust this person or I don't. Otherwise, there's just going to be the endless deciding, and I'm going to become an analysis paralysis. I will never make a decision, right? So that's a little bit easier in the fitness world. You can kind of go with your gut and like, all right, that person looks phenomenal. They look really good. They look how I want to look. All right, maybe they're not a dietitian, but clearly they've done something right. Something. They've put in effort. They're clearly disciplined enough to show that physique. In the finance world, it's a little bit different, right? Because the equivalent of that in the finance world would be only take advice from people who are driving Ferraris, who have the most expensive suits, who are always the cleanest cut, but actually that's not always the case, right? You look at Warren Buffett, who talks about the home that he lives in, the car that he drives, where he goes to go eat. You would never guess by his lifestyle attributes that he's worth what he's worth. So that's where it can get very tricky, because how do you How do you communicate with somebody like, hey, I know what I'm talking about without being flashy in your face, like, look at all this money that I have, because oftentimes
Right.
those people actually don't have as much money as they are portraying stuff.
Yeah. And so there's a lot of faux
Yeah, yeah.
faux right stuff going on out there. Yeah, it's definitely you know a thing that I struggle with a lot. Like for years, I kind of refused to live a flashy lifestyle because part of it is because I want it to be like it's a genuine, like I want to reflect like, hey, I'm just an average person just like everyone else, right? But I also understand that people are visual animals, right? They
Money
need to
talks.
see. So it's just right, money talks. And you have to find a balance. I actually kind of become distrustful if I see like a financial guru that like is too flashy for me.
Yeah,
That
you're not
is like
alone.
yeah, that for me is a red flag. I'm like, so is my money gonna just finance their lifestyle?
That's totally fair. I think there's nothing wrong with that. And that's, we can empathize being in this situation where people that we interact with, people listening to this podcast, people that we just meet in person, it is a challenge. And with so much noise out there, that kind of comes back to what our mission is, which is giving concrete advice, right? Talking both from the meta standpoint and then breaking it down as we are right now, talking about the tools and the strategies. And going back to that, I want to kind of just give an example on the finance world real quick of how we would use certain tools to implement into a strategy. So I think if the strategy is overall making money, which is a very, very vague strategy or a very vague goal, and beneath that, we need to know what the strategy is. Okay, we want to make $100,000 in 5 years, and our current positive cash flow is $10,000 for the year, right? So, or let's say 12,000, just to keep it simple, $1,000 a month. And now we're left with all these tools. All right, do I put my money into stocks and in the more traditional sense, a 401k? All right, well, when do you said you want to make that $100,000 in the next 5 years. Well, let me ask you this then, Pei. Is it possible to make $90,000 or turn that 10,000 into 100,000 in 5 years by going into a traditional 401k?
I would say no.
Sure.
Simple answer, right?
Yep.
Because that means that the tool that or the vehicle that you put that money in, your monthly cash flow, if that's the only thing that you're doing, if that's the only strategy you're employing, you're not likely to meet that goal, right?
Right.
Because it's simple math, right? $1,000 times 12 is 12,000, right? 12,000, I guess, times how many years you have to
5 years.
reach that goal, right? It's not going to be. I don't think so. Is it going to be 12,000 times 5?
Yeah, because you're saving 12,000 a year. You're technically investing 12,000. You're going to get to 60,000, and that's where, again, going back to the strategy, you have to understand. Like if you go to somebody and you tell them what your cash flow is, and you tell them what you can contribute, and they'll tell you, oh, after 5 years, I can make you $65,000. But you realize, wait, my initial contribution of 12,000 over
It's
5 years is $60,000. You've made me $1,000 a year. Like my cash on cash return is not very good on the money that I put in. Right. So keeping
so here's you gotta explain what's cash on cash return. How do you even calculate that?
fair. Yeah. And there's multiple. I think that to me, there's a black and white way, but I know that people will use it kind of on a different basis. So cash on cash return is if I put $1,000 into an investment and they say it's going to pay out 10% a year, and this can be various investments. That means that in order for the cash on cash return to be what they said, which $100 on 1,000 is 10%, just simple math. So that cash
Yeah.
on cash return is 10%. So if at the end of 12 months, if I've gotten 100,000 of interest and my original $1,000 of principal back, well, then I've made 10% cash on cash return. If, however, the investment that I put it into did not perform as expected and didn't make my $100, but instead made $80, well, then my cash on cash return is 8%, despite what the advertisement said of 10% cash on cash return. So that's how I quantify it. In my mind, it's very, very simple. You just take the interest gained divided by the principal, multiply that by 100, and that's the percentage of what your cash on cash return is.
It's not a very frequently used term to measure investment. That's why I wanted to kind of break it down a little bit for people, because I think we're going to probably use that in the future. Bring it up is going to resurface. So Let's just
So
tackle
since
it
we're
right now.
on that topic,
A lot of
how would
work.
how would you define cash on cash return versus rate of return?
Cash on cash return, I kind of see it similar to you. Like when, let's say I borrow the money, I didn't even use my own money. Let's say I went down to the bank and I borrowed the money at $10,000 and the interest rate is 10%, right? For the whole year, I'm gonna have to pay $1,000 to use other people's money, right? But if this $10,000 that I borrowed end up making me, right? Let's just throw it on, end up making me a profit of $10,000. I doubled my money. I doubled other people's money, right? That is how I calculate the cash on cash return. My cost is not the 10,000 that I borrowed. My cost was the $1,000 of interest that I paid, right?
Okay.
And then you then take that number, your cost, and you divide it by your profit. What did that money gain you? That's your cash on cash. That's how I see it.
Yep, gotcha.
Yeah.
Yeah, that's true. And that's a really good rate of return if we're talking about doubling our money in 12 months.
I know.
I mean,
Just for math's sake.
just for math's sake, I know. But it is a good place to kind of wrap that part up, because it's good to identify what are the definitions, right? What are tools? What are strategies? And how is that implemented with the big picture of cash on cash return? Because ultimately in the finance world, we're talking about wanting to find strategies to make more money. That's ultimately our end goal of what we're trying to say, is make more money. In the context of you as an audience, how that means in your life is completely different. What quote unquote make more money means to you is what you define, right? And that ultimately you have to fit that into your picture. And just on the fitness world, right? In touching on that of what your ultimate goal is, right? Using a tool, I'll give a very quick example of resistance weight training. That is a tool, and in my opinion, it's the most effective tool to help with overall lifestyle function, whether that your goal is to gain muscle or lose weight. Whatever that goal is, weight training will help you get to that goal. So that's one tool. Now there's strategies to use that, and I'll give a very quick example of, let's say you're doing 3 workouts a week, right? You only have time for 30 minutes 3 times a week. Each session is 30 minutes. All right, you're going to hit one muscle group you're going to hit one machine for every muscle group. And you're going to do your chest, you're going to do your back, you're going to do your arms, you're going to do your legs. You only have 30 minutes. So one of the strategies to use resistance training would be, you're going to do 4 sets of 8 reps. And that's what you're going to start with. And you're going to do that on Monday, you're going to do that on Wednesday, and then you're going to do that on Friday. And then the next week, you're going to use the same workouts with the same weight, but this time you're going to try to do 9 reps. So now you're using the same weight, but you're pushing the resistance up a little bit. And the more, this is called progressive overload, which at some point I will dive much deeper into this. But this is how you're going to increase your weight that you're going to be lifting, which will therefore increase your strength, which then increases your muscle mass. And two side effects of having more muscle mass is obviously you get more muscle, but also your body becomes more efficient at burning calories, and therefore you start losing weight. So that's a tool of resistance training, utilizing a strategy to build more muscle, which will ultimately reach your goal. Right. So those are kind of two ways to tie in the tools and the strategies in both the fitness and the finance world. There's so many tools. This whole podcast can just be tools and strategies. I'm not talking about this one itself, but the whole duration of the podcast, for however many hundreds of episodes we record, each episode could be one tool for finance and one strategy for finance. And then the next episode, one tool for trading, one strategy for training. So all that being said,
it's endless. It's crazy. It's amazing.
It's fun. It at the end of the day, it is fun. And that's what we have to remember, is all of this is subject to interpretation and how we want to implement this based on what our overall goal is, and understanding that our goal can move. And there's nothing wrong with how our goals move, both in the fitness and the finance world. And to me, it's exciting, but it sometimes gets a little bit frustrating. So hopefully we can help to ease that off a little bit. And I know on our next episode, we're going to be hopefully live in person, talking about some tools and strategies that you've done and that you've implemented to achieve something that you've been setting out for a while now. I think it's been in the making. So anything you want to wrap up with tools and strategies?
I think ultimately, the more we know, the more we realize we don't know. That's my philosophy. So we are on this journey to not just kind of self-discovery, but also to bring on people and talk about their discovery. Hopefully that would expand our knowledge as well. So I'm super excited. I'm looking forward to starting to expand our podcast to get the guests. We actually came up with quite a good list so far, right? So yeah, that's something I'm totally looking forward to it. It's good talking to you today. We cover kind of touch on a lot of topics that we're gonna want to deep dive later on. So stay tuned.
Yeah, definitely some unique tools. And I think what you said to sum up is great. The more tools we have, the better, because you never know what strategy you're going to be implementing, and you might need to grab a tool out of the toolbox that you thought you would really never need, or maybe you didn't need it at the time when you learned about it. But then months down the road, you realize, oh, this could be beneficial because I need to pivot or I need to diversify, which is something we're definitely going to be talking about as well. So yeah, as always, Pei, great chatting with you. I love these deeper dives as we're getting into them, and we want to encourage everybody to keep coming back because it's only going to get better. Thanks, everybody.
Bye.